Okay, so we are ready to start chapter 2. And so I gave you this handout, and this is a breakdown of debits and credits. So if you did the little adaptive learning plan, you kind of know hopefully a little bit about what debits and credits are and what that means. So chapter 2, what we're looking at is we're building on what we learned in chapter 1. So we're still analyzing transactions, but instead of just saying, you know, cash increased or decreased, we're going to start putting everything in accounting terminology. So we're going to say like debits or credits, okay? So basically, if you kind of looked over chapter 2, you'll see it starts talking about what we call double entry accounting. So double entry accounting is using debits and credits to log transactions. And how it works is we still have our accounting equation that we're keeping in balance. So our accounting equation is still important. But now we're going to use debits and credits in place of increase or decrease, okay? So we're still going to have increases and decreases, but as you see on your little handout here, each asset increases or decreases on different sides, okay? The big thing to always remember when you're starting to learn debits and credits is when you're looking at a T account. So a T account is just shaped like a T. Thankfully, it's aptly named. And it's going to have some type of account title, okay? So for instance, it could be cash. This could be a cash account. When you're thinking of T accounts, you always want to know the debit always means left, and credit always means right, okay? So debit means left, and credit means right. And from there, every account type, assets, liabilities, equity, and the different equity accounts, will just have different sides that they increase or decrease on, okay? So as long as you remember debits left, credits right, then you can kind of use this cheat sheet too. And it shows you exactly, you know, like for assets, for example, according to our sheet, you know, they increase on the left or the debit side. So if we have, say, cash, which is an asset account, if it's increasing, we're going to debit that account, okay? So again, you know, just to kind of focus on that expanded accounting equation, debit always means left, credit always means right. We show increases to assets by debiting, okay? If we decrease an asset, we credit the account, okay?
So why do they switch those words around?
Well, in accounting, again, debit just means left and credit means right. So you don't want to think about it at all from like a banking standpoint, because that's when it gets confusing.
Right.
So yeah, like if you think of banking terms, don't.
Okay.
I know that's hard, right?
Well, no, I mean, you telling me that lets me know to like let that go what the words normally mean.
Yes.
You know what I mean? Just let that go.
Just let it go. Yeah, let it go. In accounting, debit means left and credit means right. And that's really their only true meaning.
Right, left,
okay?
right.
Yeah, left and right. And so that is confusing. Like one of my best friends teaches like finance and stuff like that. And she called me the other day because she's teaching an accounting-esque course. And she's like, no one ever told me that debit was left and credit was right. And I'm like, well, you passed accounting. So, yeah, we had a nice little chuckle. I'm like, well, if I would have known that, I would have told you. But that's all it means, because she comes from the banking world. Mm-hmm. And debits and credits mean entirely different things.
Right.
So it is confusing. But debit's left, credit's right. So what you'll want to do is learn what we call the rules of debit and credit. The one rule is that assets increase on the debit or left side. And the way I always look at it is assets are on the left-hand side of the equation, and they increase on the left-hand side. So that's kind of your trick there. Liabilities are on the right-hand side of the equation. They increase on the right or the credit side. Equity overall also increases on the right or the credit side. So everything on the right-hand side of the equation, liabilities and equity, increase on the right.
And assets.
are on the left. Now, the tricky part comes into you have different equity accounts that affect equity differently, right? What two account type of equity accounts increase equity? Dividends decrease equity, but it is an equity account. Yeah, so dividends decrease equity, right? So what I do is I think of it, well, overall, dividends decrease equity. Revenue and common stock increase. Very good. So revenue and common stock both increase equity.
Because your cheat sheet says plus sign.
Yes.
Like even just oh, it's common stocks.
Okay, revenues and common stock both increase on your credit side as well because they increase equity. Okay, so I put DR and CR for short. That's the abbreviation. CR makes sense. Don't get me started. It doesn't make sense. I don't know who thought of that, but I'm like, that stands for doctor, but it also stands for debit. Accountants were weird, right?
I'm just gonna put that up in the top left corner. You know what I'm saying? DR, debit.
Yeah, it's just those abbreviations. They're nice to use. So then expenses and dividends both decrease equity. So we're going to show that by having their increase sign on the left for the debit side. Okay? So when we increase dividends and expenses on the left, they're decreasing equity overall. Okay? So they'll be subtracted out of equity. So as far as what you learned in chapter 1 about accounts and increasing and decreasing when you're analyzing transactions, all of that stays the same. But now instead of just saying cash increased and common stock increased, you want to say cash was debited because it was increased and common stock was credited. Okay? So rule 2 of the rules of debits and credits is that anytime you're logging a transaction, if you have a debit, what do you think you need to have?
A credit.
A credit. Okay, so that's a big concept of accounting. It sounds simple, but it's probably one of the most unfollowed rules in accounting class because I'll have students. I'll be like, oh, it was cash. Cash came in, debit cash, and I'm like, and what else happened? So you always have to show both sides, just like we talked about when we were analyzing transactions in chapter 1. But again, now instead of just saying increase or decrease, I don't want you still want to analyze it like that, but you want to be able to say debit, credit. Okay?
So when they only want to show one side, is that they're trying to hide?
You're not allowed to just show one side.
Right.
Like even like if you're doing computerized accounting and I go into QuickBooks and try to journalize something and put a debit in, it won't let me log it without a credit. Because you just can't. Because they want to know where that money came from or what you paid money for. That's the whole thing here. It's like, well, if you just show me cash coming in, what did you get that cash for? Government's going to want to know. Your stockholders may want to know too, and investors. So you have to show both sides. So those are the 2 big rules of what we call double entry accounting and the rules of debit and credit. So you have to follow the accounts, how they increase and decrease. And then for every debit, you must have an offsetting credit. And what that does is it keeps that accounting equation in balance. Okay? So at the end of the period, when you do your balance sheet, assets should always equal liabilities plus equity, just like they did in chapter 1. Okay? So we're just taking it a step further and putting it in what we call true accounting form, really. Because what we do, and we're going to practice, as you can see, and the chapter goes over it in more detail. But what we do as accountants is we analyze transactions. It's like step 1 of the accounting cycle. We look at what happened and figure out what increased and decreased. Then we journalize it. So journalizing is just the official way of recording the transaction. Okay? And we're going to look at kind of some simple ones here where you'll see it kind of in an unofficial journal form. And then I think we'll also look at one where you see it in more official. So a journal is just a record of all of our business transactions. So a journal is going to say like the date, the debit account, the amount, the credit account, and the amount. So you're going to see that, all the way through. So now instead of, putting it in that big spreadsheet like you did in chapter 1 where it got all confusing, you're going to have a better, more organized system of keeping track of your transactions. Another thing to keep in mind is you can still have what we call compound transactions. So we could have 2 accounts that are debited or 2 accounts that are credited. That can happen. Say you know, a lot of times one common compound transaction is, say you go buy a car and you put some money down and then you finance the rest. Okay? In that situation, you're paying some cash out, but then you owe the remainder. And you bought a car. The car is your asset, right? It's increasing. So that's one account. That's your debit. And then on the credit side, you're going to have cash going out and like accounts payable or notes payable being credited to show we still owe. Okay? So the overall underlying theme is that your total debits need to equal your total credits. Okay? So if you're logging a business transaction, your debits need to equal your credits. Whether it's 1 debit and 1 credit, 5 debits and 2 credits, you know, it can be any combination. Okay, there's no do what?
Because after the taxes and everything.
Yeah.
And if I see my personal finance classes using me with this guy.
Yeah, there's a lot of interchangeable terminology.
Yeah, a lot of stuff the same.
Yeah.
We just doing something like this today in my class. And like, they telling me something different. I'm like, oh, y'all killing me.
It can be different because, yeah, keeping track of your personal records are a little bit different than corporate accounting, right? Like the underlying principles are the same, like you have assets and net worth and all of that, but just, yeah, the terminology and what we do is just a little different. So yeah, it can be confusing.
Do that now.
Yeah, can be a little confusing. Okay, so that's what we're doing in this chapter. We're going to journalize transactions, and then we're going to post them to ledger accounts, okay? Well, I showed you T accounts. T accounts are like unofficial accounts. So what we would do is, like, for every account that we have in the business, we first create like a chart of accounts, and it lists all the accounts we use in the business. Okay, let me just I'll pop up a couple things here, and then we'll get into examples here in a second. Okay. There it is. Okay, so this is kind of a very brief example of a chart of accounts. So a chart of accounts is a listing of all the accounts used in the business. And if you notice, it starts in order of balance sheets accounts. So you have assets first, and they all start with number 1. That could be 1,000, 10,000, as long as it starts with a 1. That's just the naming. And then for liabilities, we just have 2 liabilities. Stockholders' equity, common stock, retained earnings, and dividends. And those are number 3. And then 4, we have revenues, and 5, all of our expenses. So that's kind of the typical way a chart of accounts would look. So that's the first thing a business establishes. And then these are all the accounts that are used. And so when we're journalizing, we're using these account titles, okay, in our debit and credits and in our statements and everything. So they're the official account names. We still used accounts last chapter, and they don't call them accounts in chapter 1, but I did. So it's the same idea. Cash has its own account. Well, it's like your banking account, right? You can log on and look at all the increases and decreases in your running balance. We're going to keep that for each account in here. Okay. So we have the chart of accounts, which is the listing of accounts. We journalize every business transaction as it comes in. And then we have a ledger. A ledger is just a list of all the accounts, and it shows every debit and credit to that account. So cash will have its own ledger. And every time we debit it, we'll show that, and then we'll increase our balance. Every time we credit it, we'll decrease our balance. Okay? So those are like the big points of chapter 2, is learning what a chart of accounts is, journalizing using double entry accounting, posting to the ledger. And then from there, the great thing is you have all your account balances, because when you post to the ledger, you're keeping account balances. So we'll prepare what's called a trial balance, and we'll look at that in the examples. It's really easy. And then you prepare your financial statements like you did in chapter 1. So you'll have all your account balances, so your statements will be easier because you'll have all the information. The statements are the same as they were in chapter 1. Okay, so nothing changes there. Really what's changing is that we're learning the official way to record transactions. Okay. So the journal and the ledger are both internal documents that we keep within the business, okay? And what they do is they help us produce those financial statements that we can provide to external users. So let's do some for fun here. When I lose that little thing. There we go. So this first one is just dealing with a month's worth of transactions. And we're going to use the drop-down menu instead of typing them in to save time. But it's journalizing transactions. Okay. So again, we're looking at transactions that are pretty similar. There may be a couple that are a little bit new that we haven't dealt with. I think most of these are pretty standard, just looking at them. So we're doing the same thing again that we did in chapter 1. So we're looking at a transaction and saying what to at least 2 counts. What accounts are being affected? Are they increasing or decreasing? Okay. So that part at least is just more review. So it tells us what our accounts are. You know, cash, accounts receivable, supplies, and office equipment are our assets. Accounts payable is our liability. Then we have common stock, retained earnings, dividends are all common stock or equity accounts. Fees earned, revenue account, and then rent, advertising, utilities, and miscellaneous for expenses.
Now, you know those and can dissect them that fast because you've just been doing it, but really we need to we're gonna have to figure out where they go.
Yes, yeah, you do want to review, you know, and like on that cheat sheet I gave you, you can write, you know, typical accounts under it. So like under assets, if you want to write down like cash, accounts receivable, supplies, equipment, you know, to get it in your brain, you know, what accounts are what. That's completely a great idea, actually. I encourage you to do that. So that way you know what the different accounts are.
Yeah, so I put the money in the right place.
Exactly. So we're just going to, as you can see, this is kind of an unofficial journal where we're just going to log the debit and credit. So when you're journalizing, you always list the debit first, okay? The debit account always gets listed first. So on March 1st, we paid rent for the month of $4,000. So what 2 accounts are being affected?
Accounts payable?
Accounts payable is not affected in this
I was
one,
just guessing now.
I did hear assets.
Assets are affected,
Uh-huh.
and your expenses are affected.
Good, yeah, we're paying an expense, right? Specifically in this case, it's rent expense. And then what asset account is being affected?
Cash.
Cash, good. Well, cash, is it increasing or decreasing? Decreasing, good. So when you look on your sheet, what do I do to the cash when it's decreasing?
Credit?
Credit, perfect. So if you figure out one half, you can always figure out the other half, right? And by elimination. So we would know rent expense would get debited. Well, if you look on the board or on your sheet, that makes sense because we're increasing the rent expense account. So it's going to increase on the debit side. So rent expense gets listed first. Make that a little bigger. And cash gets credited for the $4,000. Okay. And notice when I entered that in, it kind of indented cash below it. That's your typical journal entry form, is that rent expense, the debit amount is listed first, and then cash is kind of indented below it. The credit account's always kind of about 5 spaces over if I were typing it on a computer. But it does it for you automatically, so that's always nice. Okay, so rent expense debited, cash credited. March 3rd, we paid advertising expense, $13.50. So what 2 accounts are being affected there?
The advertising expense.
Advertising expense, good.
And
Cash. Good. It's really kind of the same entry, right? We're paying a different type of expense. So on that one, which account am I debiting? Advertising, very good. The expenses get debited to increase. And you're crediting cash. Okay, so advertising expense gets debited, cash gets credited. Let's see, March 5th, we paid cash for supplies. What 2 accounts are being affected there?
Supplies payable?
Not supplies payable,
Supplies, just supplies.
just supplies.
Just supplies?
Just supplies, good. And supplies is what type of account? Asset, good. So if you remember, supplies is kind of the tricky one. We consider that like a prepaid expense. So supplies, when we purchase it, it's an asset. It's something of value that we own. In this case, we're purchasing supplies. So it's an increase to the asset account supplies. Okay, that was 1,800. And what gets credited? Cash, very good. And cash gets credited. So the first three, we credited cash because we paid. So anytime you see the word paid, you know to credit cash, okay? Sometimes there's some little key terms that you can kind of link up. And there's a great slide in the PowerPoint, if you review it from Canvas, that gives you kind of that, where it's like, gives you some typical transactions and the debit and credit for those transactions. So it can be useful. There's some good resources. Okay, on March 6th, we purchased office equipment on account. What two accounts are being affected there?
Office equipment expense.
It
Or
won't be an
payable.
expense,
Payable?
but it is office equipment. Payable. Accounts payable, good. So office equipment is what type of account?
Asset.
Asset, good. Is it increasing or decreasing?
It should be
Increasing, right?
Increasing.
Yeah. So if an asset is increasing, we debit it. So office equipment gets debited. 11,500. And then you are correct. Since we owe this on account, that's a liability. And our only liability account is accounts payable. Accounts payable is increased on the credit side. So that would balance that one out. The office equipment is debited and accounts payable is credited. I'll shoot. Okay. Let's see, March 10th, we received cash from customers on account. Seems a little trickier. So what accounts are being affected there? Accounts receivable, good. Cash, you guys got it, perfect. Which one do I debit? Cash. Cash. On this one, you're debiting cash because cash is increasing. So they're paying you cash. And then accounts receivable is an asset, and it's decreasing because customers are paying on their balance. Okay, so what they owe to us
It's not going to be minus.
is now being subtracted out. Yeah. So cash is debited, accounts receivable is credited. Any questions on that one? So we had performed the service at some previous time, and now they're just paying us. Let's see. 15th, paid creditor on account, 3180. What two accounts are being affected there?
Accounts payable.
Accounts payable, good.
Cash.
And cash, perfect. So accounts payable is being debited or credited?
Debited.
I heard both.
Accounts payable is going up because you're paying someone on account, so that means it would be debit.
Yes, you would debit accounts payable because you owed them already and now you're paying it towards what you owe. So yeah, you debit accounts payable because we're reducing our debt. Okay, so like we had purchased, say, I'm assuming this is from the March 6th purchase. So on March 6th, we purchased office equipment on account. So we owed, right?
Right.
We credited accounts payable because we owed. So accounts payable had a balance, a credit balance of 11,500. Well, then we paid them money, so that accounts payable balance went down.
Wow, that's fine.
Okay, so accounts payable gets debited.
And since accounts payable is the liability, it's the one opposite, where the debit is decreased, the credit is increased.
Correct, yes. Yeah, accounts payable is increased on the credit side, so when we decrease it, we're going to debit it. Yep, you got it. And then since we paid cash, cash is going out the door, so cash gets credited.
So it can go up.
Yep. Cash definitely can go out the door. Let's see, March 27th, we paid cash for miscellaneous expenses. Yep, miscellaneous expenses. They gave it to us in the sentence, didn't they? And so we debit to increase an expense. And then what do I credit? Cash. They gave us that one too, right? You'd be surprised though. It's like, I think students read too much into it sometimes, and it's easy to get off for some reason. But yep, that's perfect. So miscellaneous expense debited, cash credited. $700. Let's see, getting towards the end here. March 30th, we paid our telephone bill for the month, $550. Yep, telephone or utilities expense. Very good, utilities expense. What was it, $550? And then what am I crediting?
Cash.
Cash, perfect. Utilities expense, debit, cash credit. Lots of expenses in this one. That's kind of typical though, right? That's how not much coming in, but a lot going out. Yeah, like the American way, right? Okay, now we're at the end of the month. We have 3 transactions on March 31st. The first one, we had fees earned and billed to customers for the month of $37,200. Fees earned, good. Did we get cash on that one?
Mhm.
Not yet.
Cash.
Accounts receivable, yeah. So which one do I debit? Perfect. Accounts receivable is an asset and it's increasing because it's money owed to us. So I'm going to debit accounts receivable and credit my fees earned, which is my revenue, and it's also increasing. And we show that
Why
as
we debit fees aren't, that's fine.
yes, yeah, it's an equity and since it's increasing equity, it also increases on the credit side. So it takes some time to get these down, you know, that's why I usually try to write it on the board and then give you that handout, so it helps. So accounts receivable debited and fees earned credited for services performed on account. Again, we have another one, paid electricity bill, $830. What's my debit and credit there?
Utilities payable.
It'll be a utilities expense. Yeah. And then what's my credit?
Cash.
Cash. Perfect. So they kind of throw you off putting those payable accounts out there. Utilities, when we actually just write the bill, we get the bill, you know, and then we pay it that month. So any type of expense that we get the bill and we pay it when it's due is just an expense. Okay. So a payable comes into play when we are not paying it and we owe it. Okay. So they kind of throw that in there to confuse you because you probably won't really ever use utilities payable. The only time you do is like when you receive a bill and you're going to pay it later. So you log it as an expense then, and then you're going to pay it later. So that one's a little tricky. I don't like it when they throw in that.
I'm gonna create that own category. So I'm gonna pay you later.
Yeah, checks in the mail. And then the last one, let's see, we paid dividends $2,000.
So that's just regular dividends.
Yep, dividends. And what other accounts being affected?
Cash.
Cash. Yeah, dividends is your equity account. So dividends gets debited because we show that as an increase as a debit, and then you credit cash. Well, dividends isn't an expense account. It's kind of a tricky, it's its own account. Okay, so dividends are just money we pay to our stockholders.
So why would you credit cash and not common stock since dividends are part of equity?
It's a good question. The dividends account itself is part of equity, so that's where the equity is going down. And so, but you are actually writing checks to them, so that's why the cash is going down too. That's a good question. So yeah, dividends is its own account, but it's still an equity account. So your equity is decreasing when you debit that dividend.
Oh.
Yeah, that's a great question. Okay. And then you can always check your work if you want. Should be correct. Any questions on that one at all? You guys seem to be pretty good at determining these. I feel pretty good about it. Hopefully you do.
I gotta read more.
reading is good. But practicing is also really good, you know, just practicing these over and over. Okay.
Well, it's just the other language, you know.
It is. Accounting is its own language.
You know, speaking in that form and getting the information like it's supposed to be read.
Yeah.
Whoever created this, whatever.
Yeah. Yes, sir.
On the other little sheet we did, my computer is telling me that the dividends expense on the very end of the wrong account.
Oh, it's just dividends, not dividends expense. So if they have an option for dividends expense, you just want the dividends account. No, we had that question, but dividends is just its own account. It's not actually an expense account. It functions like an expense, you know, it increases on the debit side, but it's its own. We keep track of it separately. Yeah, they threw that one out there to trick you as well. So yeah, there's no dividends expense account. They just put that one on there for fun. Okay. This second little exercise is showing you a little bit more like journalizing and posting. Okay, so again, we did journal entries that last one, but it was just dropped down, not in the true form, which I'll show you what a true journal looks like here in a minute. But this looks a little bit more like a journal. So a journal is an official document for a company, but again, it's more internally used. So when you have a journal, you're going to start with page 1, and then this company has obviously been established a while because they're on page 91 of the journal. So that journal is a living document. It just keeps going and going. So even if you do electronic, which, I mean, I don't know anyone that keeps accounting records by paper anymore. Maybe like a very small nonprofit, like, you know, club or something. Even then, they probably use Excel. You know, even in an electronic version, you're still going to see these pages in your journal. Okay, so it's very common to have that page format. Okay, so we're on page 91, and then this is your standard like format for your journal. Okay, so you always list the date first. It's October 3rd, 2018. And then they're going to have a place for your account. And then that's not necessary. You have a post reference and a debit credit. Okay. So again, the journal is where we're just putting in the debits and credits for every transaction. What we just did in the first exercise. So we're going to work on this one. We're going to work on not only journalizing it, but then taking and posting it to the ledger. Okay. So let me actually, before we do that, so this is showing you, you know, kind of the layout of a journal entry. Okay, so again, step 1, you always put the date, like November 1 and the year above it. You would only list the year at the beginning of a page or when it changed. So we don't have to put 2017 on every or 2019. And same with the month. A lot of times you won't list the month unless it's a page change or a month change. So you just put the date. And then again, it's just like we did on that first example. So you're going to have a description or account. So we list our debit account first, cash, and then it's over here in the debit column, the 25,000. And then on the second line, we indent and we list our credit account, and then that amount is put in the credit. So really, the indenting is just for making it easy to read. You know, it's a little bit easier to see what the credit account is when it's indented a little bit. And then on the third line here, step 4, it gives an explanation of the transaction. You won't be doing that in this class to save time, you know, but in the real world, we would usually put in some description. Most of our transactions are pretty self-conveying as far as what's going on. But, you know, in-depth accounting, sometimes it's good. It might be like a correcting entry or something that we need to identify. So that's what that description is for. And then the last thing that we do is what's called the post reference. Okay. Well, to understand that, let's see, find the. This is kind of showing you a little bit. So here's like a journal entry that they did where they debited prepaid insurance and credited cash. Well, what the post reference is then the journal is one record, and the ledger is a totally different record. The ledger, again, is a grouping of all of the accounts. So like in this instance, we have a prepaid, I know it's kind of hard to read, a prepaid insurance ledger account, and we have a cash ledger account. So this is like in the ledger where we're keeping track of all the debits and credits to each specific account and a running balance. So we know how much cash do we have on hand, how much revenue have we earned in the period, okay? So what we do is we journalize, and then we take that journal entry and we post it to the ledger accounts. So prepaid insurance increased with the debit, and so I see that in my little ledger account. I'm putting in the date. We won't worry about that item column this chapter. And then I'm debiting it, and so its current balance is a debit of $2,400. Okay. And then that post reference, I always put the journal page it came from. So in this case, it came from page 2 of the journal, and that just is a cross reference, so I can go back and find that transaction if I need to. And then I take the account number, prepaid insurance account 15, and put that 15 on my journal to show I posted it, and again create a cross reference. So that's the last step, is taking that journal entry, posting it to the ledger account, and doing those post references. So that creates a cross reference so you can go back and look it up. And then also when you're going through your journal, if you do the post references when you post, you know where you left off. Okay. So we also see cash was credited $2,400. So before that entry, it had a debit balance of $5,900, and we subtract that credit because the credit decreases cash, and we get a new running debit balance of $3,500. So that's what those ledger accounts do, and we'll be practicing this a lot, but that's just kind of what the journal and the ledger are for. So the journal is a list of all of your transactions, and then the ledger is keeping track of each account, all the increases and decreases in the balance for each account. So they're both very important. So this next little exercise is important because it's showing you just that. So it wants us to do a journal entry and then post it to the ledger accounts. That's all we're doing. Okay. So it says on October 3rd, we purchased $3,600 of supplies on account. So what two accounts would be affected there? Very good. Supplies and then accounts payable, right? So we have supplies. Is supplies increasing or decreasing? Increasing, good. And so what type of account is supplies?
Supplies.
It is an asset, good. So if it is an asset and it's increasing, we're going to debit it. So the supplies account gets debited, $3,600. Supplies gets debited. And then accounts payable is a liability and it's increasing. Accounts payable gets credited, $3,600. So we need to do the post reference, but we're going to do that as we post this to the ledger. Okay. So it tells us down here, if you scroll down, this first one is the general ledger for account supplies. So we're dealing with the supplies, and it's account number 15. And I need to read up here. It says, enter our debit balance is $770 as of October 1 in the ledger account. Okay. So on this first line where it says the October 1st balance, I'm going to come all the way out to the right, almost the right, and put in an existing debit balance of $770. And then it just said to put a little check mark in the post reference for that line. So that balance was already there. On October 3rd, we debited supplies $3,600. So I'm going to come on October 3rd, and then the debit, put $3,600. Well, how many supplies do I now have?
16. Number 15.
4,307.
Very good, 4,370. I had 770, and I added in another 3,600. A debit plus a debit equals a new balance of 4,370. Okay. So every time I do a journal entry, I post it to that account so I see in the ledger how all the accounts are being affected. And then I just need to put my post reference in. So on your ledger, I'm going to put in the journal page number, which was 91. And we got that right up here. It's 91 page number.
Oh, okay.
And then on the post reference on my journal entry, I put in my account number. So supplies is 15. So I put 15.
And 21.
Yes. Okay. So that was for supplies. The next step has us dealing with the accounts payable, which is account number 21. So it says enter a credit balance of $26,200 as of October 1st. So I'm going to put a check mark on my post reference, come all the way out to the right, and put in my credit balance of $26,200. So $26,200. And then I look up here again on October 3rd, I credited accounts payable $3,600. So on October 3rd, I'm going to show a credit of $3,600. And we have a credit balance plus a new credit. So we'll have an add those together. And you should have a new credit balance
Oh, okay.
of $29,800. Okay. And then we do the same thing. In this accounts payable ledger, we put the journal number, page number it came from, so the 91. 91. And then at the top transaction, I put a 21, which is the accounts payable account number.
Okay.
Okay. So there's our journal entry, and then we've posted it to both of those ledger accounts, supplies and accounts payable. So that's just one
Can you
example.
go down to C and D on that? There we go.
And then the last one, E, it just says, do the rules of debit and credit apply to all companies? Yes, they sure do. Yes. Any questions on that one? So you'll be practicing that in your chapter 2 homework. And then I think we'll probably change our schedule a little bit because I like to spend a little more time on chapter 2. So probably next class we'll start working on the project. We have a project where you'll be journalizing and posting and doing statements and everything. And I like to start it in chapter 2 because you will get that extra practice of journalizing and posting before we test. Okay. Now we'll finish the project in chapter 3 and 4, but we can do a lot of it. So you'll probably see some updated dates pretty soon, hopefully this afternoon. So be looking at that, but you can go ahead and be working on chapter 2 homework. That'll make the project easier if you kind of get this journalizing and posting experience. Okay. Alrighty, last one. This one's a little different. This one's actually showing us all the T accounts, which are all the increases and decreases for the accounts. Okay. So it's kind of like a ledger. It's just showing in a T account, so unofficially. So it says Net Tours is a travel agency. 9 transactions are recorded during April, and they're in the T account. So you could kind of trace them. They're all numbered. So on number 1, we got 50,000 of cash, and we can trace that to the 50,000 credit to common stock. So we're not actually going to go through and journalize these. What we're going to do is actually prepare what we call a trial balance. So we have to balance some of these accounts though, because we don't know the amounts that are ending them. Okay, so that's always something when I'm looking, whether it's in a ledger or in a T account, I need to keep a balance too. So to balance a T account, I'm going to add up all the debits and add up all the credits and subtract. It's pretty simple, right? So for cash, I would take 50,000 plus 8,700, so 58,700, and then I would subtract out those 5 decreases. Okay, so you should get, just to make it quick, you should get 41,950. Well, when I'm looking at where do I place that? Do I place it on the debit or the credit side? What do you guys think?
be on the credit side.
Say that again.
I would say
50,000
debit
plus
because
what?
plus.
What side of debit? Okay, yeah. That's what I meant. The
That's
left
good,
side. I
yeah.
thought just.
Yeah, I meant left, yeah. Sure, no, okay. It's easy with cash to get confused because we think of credits as increasing with cash, right? It's in our brains. When you get credited, you're like, woohoo, I got money. But yeah, cash increases on the debit side. So our cash coming in is greater than our cash going out. So that balance is on the debit side. So when you're balancing an account, the ending balance should be the normal increase side. Okay? So like for all of your assets, they should have ending debit balances. Okay? Or normal balance, that's what they call it in the chapter 2. A normal balance of an account is its increasing side. So you're completely correct. It's a positive amount, so we're going to list it on the debit side.
So if you're in a negative amount, what you do?
Yeah, you sure would. Yeah, if for some reason like we overdrew our account, and you won't see that in this class, but we know it happens in the real world, unfortunately. So absolutely. So typically though, the accounts are going to have a normal balance, okay? And like revenue, for example, as of this point, you're never going to see a debit to your revenue. Revenues are always money earned, so it's just going to be credit, 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 credit. So you would just add it up. Okay? So for cash, I kind of told you, yeah, we took 58,700 minus all of that, and that was a positive amount. So it should have a debit balance of 41,950. Well, when you're doing a trial balance, as you can see, it just has like the company name and then the words unadjusted trial balance. We'll talk about that when we get to chapter 3, when we do adjustments, what an adjusted trial balance is. But right now, they're all unadjusted, and then the date. So what you do on a trial balance is you list all of the accounts that you have from your chart of accounts in order, and you list their ending balance. The biggest mistake I see is that people will add up all the debits of cash and put a debit amount there, and add up all the credits and put the credit amount there. That's not what you want to do. You want to end with just one balance. So again, all of your assets should have debit balances. So I'd start with cash. And I would put in the amount, the 41,950. So again, we took our debits minus our credits. And cash ended with a positive debit balance of 41,950. Okay? And then I would just list the rest of my accounts. So my next one, it kind of goes down. So the next one is accounts receivable. Well, accounts receivable is also an asset, right? So I would take a debit of 18,200 minus a credit of 8,700. And what would my balance be?
17.
9,500.
Very good, 9,500. So we're subtracting. And is that a debit or a credit balance? Debit, very good. Because again, accounts receivable is an asset. So accounts receivable will have a debit balance of 9,500. Our next account is supplies. Well, what type of account is supplies?
It's an
Asset.
Asset, very good. I'll just wait. Like, I'll get it eventually. Supplies is also an asset. So it has 3,400 debit and 1,100 credit. So what would I put as its balance? 2,300, perfect. And is it a debit or a credit?
Debit.
Debit. You guys got it. 2,300 debit. Okay. The next one, we go up to the middle here. Equipment. What type of account is equipment?
Asset.
Assets. Okay. Well, it only has one entry. That's real difficult then, right?
Mm-hmm.
So equipment has an existing debit balance of 15,000. 15,000. Let's see, next.
Is that negative? Sorry about it.
Do it.
Mm-hmm. Yeah.
And accounts payable, it's not actually a negative amount.
No, because it's the other way around.
Accounts payable is a liability.
Yeah.
Yep. So accounts payable, since it's a liability, it's increasing our normal balance would be the credit side. Yeah. So what is accounts payable balance?
75.
Very good, 7,500, and it's in debit, or I'm sorry, credit balance So accounts payable is a liability account. So its normal balance should be a credit balance, the 7,500. And what that's saying is we still owe 7,500. Okay,
But it's all good though.
it's all good. We all owe.
They might get it.
We'll pay on it.
Right, I know. It's coming. I promise.
Common stock, it obviously just has a credit balance of 50,000. So that one's pretty easy.
Right.
Common stock is an equity account. It increases equity. So it has a normal credit balance. Next one we have is dividends. Well, we know dividends is an equity account. What's dividends? Well, it shows us. It has a debit balance, right?
Right, so it's gonna be.
It's just that 1,000 debit balance. So I list dividends.
And we didn't pay our people
$1,000 in dividends. So that's a debit
much.
balance.
Service revenue.
Two left. We have service revenue. Well, again, revenue increases equity. It increases on the credit side. And we see that because it has a credit balance of 18,200. So I put that in. Service revenue, 18,200 credit. And then last but not least, we have operating expenses. Well, expenses increase on the debit side. Here we have two expenses under that. So I just need to add them together, right?
59.50.
Very good. 5,950 debit to operating expenses. 5,950. So once you put in all the ending balances on a trial balance, what you do is you add up the total debits and then you add up the total credits. And if we did everything correctly, they will equal. Okay. I'll let you guys, if you want, I'll let you add that up and then you can just tell me when you get a total.
For the credit side, I got 75,700.
Perfect. 75,700 on the credit side. Good.
You do a whole lot of debit and credit on my accounts.
The same for
Very good. Yeah, we got the same, right? You should get 75,700 on the debit side as well. And that's good. That's what we want. So we're showing, that's what a trial balance shows, is that our total debits equal our total credits. So we did a whole month's worth of transactions. And could we have made a mistake and put something in the wrong account? Possibly. But at least our total debits equal our total credits. Okay? And when you're going through and doing trial balances, you'll either get it from T accounts or from the ledger. You'll have ending account balances you grab in. If you have a mistake, the first thing I would look for is just to see if maybe you listed a debit as a credit or vice versa when you were doing the balance. Yeah, one too many zeros, you transpose numbers, check your math on the trial balance before you go, looking through accounts, because it could just be you transposed something, wrong. Or I put like equipment as a credit or something silly. Okay, so there's usually some common little mistakes that get made. So that's a trial balance. So what we do in an accounting period is, as we've done, we analyze transactions, we journalize them, we posted them to the ledger, and then we're now at the end of the month, so we get all of those account balances from the ledger and we do a trial balance. Okay. This trial balance I would then use to prepare my financial statement, because you have all of your account balances. So now it's pretty easy to go in and do your income statement, then your retained earnings statement, and your balance sheet. So I would just print that off, prepare my statements, and we're done for chapter 2 at least. So we learn more stuff, right? So the last little question, it says, based upon this trial balance, what's your net income or net loss? So how do you calculate net income or net loss?
You guys divide them by ratio up, that's the other class. Sorry.
Do what?
I'm talking about dividing these ratios. I don't know why I'm thinking about the other class here.
Yeah, you don't need to divide. No ratios yet. Not till financial accounting. We won't throw ratios at you in this class.
Zero.
0?
I don't know, I'm just guessing, man.
Well, how do you calculate your net income? What is net income?
Let's just subtract it now.
You do subtract.
It's, well,
There's gotta be a number, another number somewhere.
It's not 0. I'll tell you that. I'll give you that hint. It's just 2 accounts you subtract.
Your revenue minus your expenses.
Very good. Yeah, net income is revenue minus expenses. So in this case, we have revenue of $18,200. We only have one expense, $59.50. So I would take $18,200 minus $59.50. That's what you do on your income statement, right? Okay. So since our revenue is greater than our expenses, we have a net income. And what was that? $12,250. Okay, so revenue of $18,200 minus our one expense account of $59.50. We have net income of $12,250. And we would see that when we prepare the income statement.
so it's revenue minus
Expenses. So we only had one expense. Generally, we'd have more than one. But yeah, it's all your revenues minus all of your expenses. Any questions so far on chapter 2 stuff? A lot of new stuff. Okay. So again, what I want to do, I think, pretty sure, like 90% sure. Just kidding. Next week we'll come in and we'll start working on project 1. And so we'll talk about that. I'll show you how to get started and get you started on that, because I want you working on chapter 2 homework and project 1 in this chapter so you can really get it down before we test. So we will not be reviewing next week, because I think according to my schedule, we would be reviewing chapter 2 and then testing. So I'll be updating dates, so you'll see that change, okay? But be working on your chapter 2 homework for next week still. You'll see that date change, but still try to be working on it. That way, if you have questions for me next time, we can get those questions taken care of before we get to review time. Chapter 2 is a really important chapter. Understanding debits and credits is something we still do like in the upper level accounting classes. So it's a huge thing to kind of understand. If you have any questions, feel free to email me or come by my office. Otherwise, have a great week. Go to the fair. Yeah, I know. Gotcha.
I'll go to the,